Hi, this is Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Today, I've got a great special guest. Grayson Waechter is joining us. Grayson is responsible for the technology subsector of our portfolios. Grayson, welcome to the show.
Thank you, Mike. Good to be here.
Great to have you. So, for those who keep track of such things, technology is a subsector of our industrial sector. Call it the larger component is the industrial, and again, technology is that subsector. So, Grayson, why don't we start there? How would you define, companies, holdings that are in the technology subsector?
Yeah, absolutely. So I would define them with technology making it a little bit different than the other sectors. A lot of technology is new. It's cutting edge. They're creating something new. A lot of times there may not already be a market for what they're selling. Since there's not already a market, there's a little bit more risk attached to those types of companies. So I would divide them as characteristic as the company as they typically have a little bit higher growth. And because of that growth, they're a little bit more volatile than a typical company that's in a different sector that's already in an established industry. A lot of these companies are also established. So for an example, Microsoft, but they find ways to reinvent themselves to offer new products that didn't exist before.
Okay. So from the perspective of our portfolios, how would you compare, call it the weighting, in terms of what percentage of our clients' assets typically set in the technology subsector compared to the market indices?
Okay. So there are three markets that we typically invest in, the Canadian, the US, and the international. So technology is weighted in Canada as about 7 to 8% of the entire S&P TSX. Now, what makes that kind of interesting is it's very volatile, so it goes up and down. Now, the US is about 30%, give or take, in their technology index, and the international one's about 8 to 9%. And that's all of it about the end of last month. So when we look at what type of exposure we want to have in our clients' portfolios, we'll take a look at the actual index itself. So I said the Canadian index is 7% of the TSX. The top three companies, Constellation Software, Shopify, and CGI, make up 70% of that index. Whereas the top three companies, Apple, Microsoft, and NVIDIA, make up the top 50, a little over 50% of the US index. So we kind of look at that and we definitely want to see, where do we want that exposure? Do we want to play in a real small pool like the Canadian market when it comes to technology, or do we want to go for those bigger names and higher quality, in our opinion, in the US sector?
Right. So, and that ties back to the whole Q-sect approach in terms of trying to basically park the geographic biases and again, just pick the highest quality firms in each sector. So coming back to weights, so, in a typical portfolio, I would assume we tend to underweight compared to, say, the typical market of what weighting we would put into technology. Would you agree with that?
So I would agree with that. Over the last 20 years, the technology sector has grown and grown, and we've participated in that, but we haven't kept up with the growth that it is. So right now, if we were to look at all three of those markets and try to see if we wanted to be the same weight as those markets in a client portfolio, we would have to put 20% of their portfolio of equities in technology. And when it comes to technology, there are some characteristics we don't like about it. We like the growth, but it typically doesn't pay a dividend, and it typically has more risk and volatility. So by underweighting it slightly, we're able to eliminate some of that volatility in our clients' portfolios while still participating in the growth of the sector.
So then, Grayson, talk about our strategy in this subsector, the Q-sector approach, specifically technology. How do we make investments then in this space?
Yeah, so technology and our Q-sector approaches, we look for quality. So one of the things that makes technology a little bit different is quality has been something we've been adding in these individual names. We originally started out with looking at technology and trying to say, you know what, over the next 20 years, technology is going to play a bigger role in our life. And it might be a little hard to pick the winners and the losers. So what we originally did was just bought a basket of the technology index in the States. And that has performed fairly well. And as we've been evolving and as technologies become a larger part of the market, we've been adding quality names to our portfolios. So we're not interested to make sure that we have exposure to one particular thing. We want to make sure that we have exposure to a quality company that has shown their ability to adapt and to make money and profitability on new trends.
So let me just play back what I heard. You're saying, yeah, Mike, it's pretty tough. Coming back to the definition of technology, by definition, it's something more leading edge. It's leveraging technology, pushing innovation to the point of, well, let's call it what it is, risk. And so we've seen how some of those bets can play off if you can get in early, but in order to get early, you've got to take some risk. And that's something in terms of the quality approach, very difficult for us to digest or propose to clients. So first we have an element that is, as you say, the basket, call it an index of some sort, correct?
Correct.
That's a basket of that has a basket of tech stocks in them, and then we surround that with a few of the again quality tech sector companies that we feel past that, our approach in terms of looking for that long-term investment. So maybe you can talk about some of those individual names that we have in the portfolio.
Yeah, absolutely. And I can also talk a little bit about how it's even hard for those companies to compete in technology, but we want to make sure they have a good management board. So I'll give an example, Microsoft. We love Microsoft. It's performed very, very well. It's had some fumbles though. There are no Microsoft phones. For an example, they didn't get into the phone network. They also are not the biggest player in search. That's Google, another name we like to invest in, but their ability to perform and deliver results, they are leaders in the cloud field. So they've been able to grow and drive revenue on that field. So even though out of the three things, only one was a success, because we're picking a good quality company with good management, we have faith that, at the end of the day, they'll knock that one out of the park.
Okay, so that's Microsoft. You mentioned Google as well.
So yes, so Google is a little bit newer of a company, and we like that because essentially they're search results. So they're online advertising company, but they use technology to do it very, very well. And with Google, what we really like is the fact that they are able to innovate, and they're also able to purchase companies as well when they see an opportunity. So a lot of times people think YouTube's synonymous with Google. A lot of people, what they don't remember is Google went out and purchased YouTube. That was an investment they made that they were able to capitalize nicely on. Another company that we had added to our portfolio is Apple. So Apple is fairly dominant in the smartphone business. They're able to basically grow revenue year after year after year, as well as they have a very solid customer base that's very loyal to their products. And then the last one that we have, which is a little different than the other two, is Visa. And Visa, a lot of people think of Visa and they say, that's not a technology company, but Visa themselves, they just operate a payment platform. So they don't make any loans personally to the clients or customers. That's the bank. What Visa does is they just make sure that you can enable global payments in a global payment system as well. So with those picks, we like to complement having that sector exposure to the technology ETF with some quality names that we feel are going to perform very well.
Yeah, and it's important that people understand that Visa is really just, as you said, a technology platform, a payments platform. A lot of people, you think about, typically they see their bank, but it's the bank licensing that technology in terms of implementing their credit card solutions. One that you didn't mention was, say, Meta, Facebook. Why are they not in the in our core pick list?
So we have looked at Meta, and we've kind of looked at their business, and we've essentially, we do like it, and they do have very strong growth, but they do have a lot of exposure in the news that we feel to be risky. So for an example, the last US election, they were all being hauled in front of Congress. So we felt that is a lot of political exposure that's in that company. And there was a lot of questions about what they had was a monopoly, and how was that affecting society. So that was an example of very good fundamentals on a company, but when we were looking at some of the external risks, we just felt that there were better avenues to put money for our clients to work elsewhere.
So generally speaking, how has technology performed so far this year?
So far this year, it's performed fairly well. Last year was a down year for that. I think a lot of clients would have kind of noticed that their portfolios didn't fall as much as the broad markets had. And a lot of that had to do with the pullback in technology. This year, technology has done fairly well. The technology sector, the TSX, is up about 43%, and the technology sector, the S&P 500, is up about 38% in US dollars. And that just goes to show how volatile it is. One year it's out of favor, next year it's roaring back. So we want to make sure, as part of our rebalancing process, that we take advantage of those pullbacks, and that we make sure we're taking profits off the table for our clients when those good years like this year is happening.
So let's talk about the current buzz from a technology perspective. Artificial intelligence, we'd be remiss if we didn't talk about it. Obviously, lots in the news. People who use Chat GPT, pretty impressive tool set, and likely going to cause, for sure, some disruptions. Why don't we start there? First of all, how would you define artificial intelligence from our perspective?
Great question. So I would define artificial intelligence as essentially computer programs and software that are designed to mimic or recreate the human thought process. So essentially designed to just take that to the next level and recreate things that only humans are able to do.
Yeah, I think that's a good summary. My background, I've been way back when I was an engineer that did a whole whack of computer science courses. And even back in the late 80s, we were looking at it way back then, late 80s, previous century. We were looking at artificial intelligence. And you're right, basically, it was mimicking kind of the process, the thought process. Back then, it was incredibly archaic and slow. But in terms of trying to architect systems that could replicate, basically take the concept of learning and apply that to systems to offer value to humans, so to speak, right? So what's our position when it comes to artificial intelligence, given all that we're seeing in the news? What's our take from an investment perspective?
Excellent question. So we do have exposure to artificial intelligence. For an example, the Chat GPT software that we have, Microsoft owns 49% of it. So what I would like to caution a little bit on is Microsoft's a large company. This is something they've made an investment in. It's most likely going to take them 5-10 years to grow it, to make it turn into something. Now, with them, there's a few things that they're most likely going to do with it. Their cloud software is actually the cloud software that runs the software itself. So an investment in that made a lot of sense for them. The other thing with them to keep in mind is, a long time ago, their cloud business used to be very small, and now it's one of their profit drivers. So this is going to start off as something that's small, and it may become more down the road with regards to Chat GPT.
Let's talk about NVIDIA. And again, lots in the news. Stock has just been on a tear. What's we're not invested in NVIDIA. Is that something? Thoughts about that? Why did we not invest in NVIDIA?
So with NVIDIA, something we've taken a look at, and we've been looking at ever since COVID. We've had this trend where semiconductors, those little chips and components that are invested in, that go into computers and things like that, they became large in demand. Everybody was staying at home. Everybody needed more electronics, and they weren't available. So at that point, we had taken a look at it, and it had become fairly expensive. So one of the things that we look at, if a company is expensive or not expensive, is something called a price to earnings ratio. It basically just says, based on last year's earnings, how many years would it take for you to recoup your initial investment? So if, for example, earnings were $1 and the price to earnings ratio was 1, the stock would cost $1. If earnings were $100 and the P ratio was, let's say, 10, the company would cost $1,000 a share. So we do take a look at that. Now, NVIDIA has always been a little bit expensive on that end. And ever since COVID, that expensive ratio has really just kind of driven up to the point where, for an example, today it's trading at about 220 times last year's earnings. So to put that into context for our average listener, they would have to grow their earnings by about 50% for the next 10 years to be able to justify their price today. Now, the market may think that that's going to happen, and it may happen, and people may make money on that. But when we look at the risk, that's a pretty hefty proposal, even for a company that's in demand. So we look at that and we go, okay, let's go back to quality. It is quality, but it's expensive quality. Is there quality that we find more value in? And we can compare that to, Microsoft or Google. And right now we feel that our clients' money is better off there. It is something that we constantly look at. So if something were to change, or if we felt that value went back on the table on a company like NVIDIA, it is something that we could add in the future.
And that's so important. And this is, we see it in other sectors as well, but mainly in technology, where the market reacts, it gets, call it frothy. This is how bubbles form. I'm a child at the turn of the century, when it was all about those, photonics and optical networking back in the days when Nortel existed, and we saw the fallout of something like that. And so that's, to your point, I'm not here to say that we're starting to see a bubble in the field of artificial intelligence, but when you see frothy valuations like you're talking about with NVIDIA, that's got to be concerning. And even though I'm sure it's a quality perspective in terms of how NVIDIA is run, I've always been impressed with those guys. When you look at those prices, at some point there'll more than likely be some form of correction. At least that's what we've seen in the past. So I think that's good insight. So looking towards the future, what do you see for this subsector for IAIC?
So looking towards the future, we definitely see it becoming a larger part of the client's portfolio. We want to make sure, though, that we're not having it be too big. We're not betting the farm on one sector. We go back to that diversified approach of there are multiple sectors that we like to diversify our clients' money into. As technology becomes more and more and more part of our life, we do see that it growing. Will probably always be a little bit underweight, but go back to the approach that we had where we started off technology being smaller, and we just had that basket of technology stocks that we invested in, and we started adding quality names to it. Going forward, I see us adding more quality names, and as that quality comes available and we identify it, having clients' portfolios add a modest amount more of technology into that, just so that there's not the same amount of gap between what the market is and what's in a client portfolio, but we still have it to a good manageable level that our clients are comfortable investing in.
Makes sense. Grayson, thanks for this.
Oh, thank you, Mike.
As always, folks, if you have any questions, feel free to reach out to your financial advisor or your IAIC portfolio manager. And as always, don't hesitate to reach out to myself. Take care.